Now we're going to get into the details. We'll start with the discount rate. And we said the first number we need in order to come up with the discount rate, the value Walmart, is the risk-free rate. We are going to use the current 10-year Treasury yield from Yahoo Finance. Let me shorten the title of this. And so we'll just go over the Yahoo Finance. Here's Yahoo Finance. You've been in this a few times in this class. If you click over here on the right button, you'll find the 10-year Treasury. You see today, I'm going to round it up to 0.7%. I'm doing this in June, so who knows what it'll be by the time of your class. But 0.7%, so 0.7%. Now, what do you do with this number being so incredibly low? Do we adjust it in some ways? It might have a class where we spend the entire class just valuing a stock. And in that class, we talk about other approaches. But for us, we're going to simply use the current 10-year Treasury yield. There's a lot of debate about whether we should normalize this or use another, maybe use a forward rate, what the bond market actually is forecasting the 10-year Treasury to be in 5 years. There's other approaches for this, but we're going to stick with the 0.7. There are some articles, if you're interested in this, there are some articles. There's a professor, his name is Dr. Dam Darren. If you search for him on the web, he has several articles on all of these issues, the risk-free rate, the market risk premium, on beta. He has a lot of issues. And he argues that we should just use the 0.7%. That's the current number. We should use it. I use a different number than what he recommends, but it's not going to be radically different. Interest rates are low right now, and that gives you a very low risk-free rate. Now let's talk about the market risk premium. So here what we're going to do is the implied approach. So what we're going to say with the market risk premium is there's going to be a few steps here. So I'm going to add a couple of rows. Now for your purposes, you're following me, you'll have to do this with your team, and it's going to be a team effort. So you might want to just follow where I'm actually calculating, where I'm putting the actual assumptions in. The rest of this is just boilerplate to let you know what we're going to be doing and discussing. So to do the market risk premium, we have to talk about the implied approach, what the implied approach says, and we'll talk about this in class as well and in the video, so you may have already seen some of this. It says that the expected return on stocks should equal the required return on stocks. Those two numbers should equal each other if the markets are efficient. If the expected return on stocks is higher than what people require to cover them for risk, then stock prices will shoot up. If stock prices shoot up, then the expected return comes down, because the more expensive a stock is, the lower its expected return, all else equal. And in the market risk premium, we actually need the required return on stocks, but there's no place to go and get that number. And so what we're going to do is just assume that what we expect stocks to return is also what we require them to return. So if we can come with an expected return on stocks, then we can come up with a number for the market risk premium. The expected return on stocks is going to equal the current dividend yield plus the expected growth in earnings. And here we're not talking about, and this is very, very important in your case, we're not talking about the current dividend of the stock you're valuing. We are not talking about the expected growth in the earnings of the stock you're valuing. We're talking about the current dividend yield of the market and expected earnings, growth in earnings of the market. This is the market risk premium. This is the premium we have for being in the stock market. So it should be the same number no matter what stock you're valuing. That means every team could come up with the same answer, but I want each team to do their own analysis and do their own assessment. So the current dividend yield we can again get that from Yahoo Finance. Let me give myself a little bit more space here. So if you go to Yahoo Finance, what we're going to use for the market is the security called SPY. It is an exchange traded fund, which means it's like a mutual fund, but it's a mutual fund that can be traded during the day. And so the SPY is the S&P 500. Anytime you hear the word market, when it comes to market risk premium or beta or anything else, we usually mean the S&P 500. But the S&P 500 up here on Yahoo Finance is a price-only index. It doesn't include dividends, whereas this SPY has dividends, and so it has a dividend yield. And there it is right there. The dividend yield is 1.9%. And so I can now use that 1.9% as my assumption for the current dividend yield. And now what I need is expected earnings growth. We're going to notice that this is going to get it's going to be build and build and build on itself. Expected earnings growth is going to equal something very close to expected nominal. So we say nominal because we want inflation as well as real growth. Nominal economic. We'll talk about this some in class. There's a really good research paper that I'll give you access to. It's an interesting read. It may not be something you definitely want to read, but if you're interested in stock markets and valuing stocks, it's a really good read. And they actually show you historically that this is the case, and I'll show you some charts in class that show you this is the case. But for our purposes here, just to get through what you need to do for your team case, I'm going to shorten this a little bit, and we'll get into more details in the presentations. So expected economic growth should equal expected productivity, the most important part of growth, plus expected labor growth, plus expected inflation. So where do we get those numbers? Well, I'm going to give you a chart. I'll show it to you here at the bottom of this page. That's going to show you those three pieces over time. What are the pieces of economic growth historically? I do it by decade. You can certainly see there's a lot of difference between a decade, mainly driven by the purple bar, which is inflation. Inflation is the most volatile part of this, especially in the 70s. Here's the medians over time. If you look at productivity, it's ranged from 2 to 3%. 2% in the 50s, 3% in the 60s, below 2% in the 70s, really weak in the 80s, a little bit stronger in the 90s, pretty strong in the 2000s, and then the last several years, productivity in the U.S. has been very, very weak. Some people find that hard to believe because of the internet and artificial intelligence and more machines. But I think part of that is that the U.S. economy, because we've automated so many things, the part that hasn't been automated is the service sector, which includes, retail, includes education, medicine, areas where productivity has really not been as powerful. In medicine, we certainly have a lot of new tools and machinery, but it doesn't necessarily reduce labor. It simply makes the machines more effective and more powerful, but you still need the same number of people, maybe even more people to run it. Education, there's been little improvement education productivity-wise. We'll see what COVID-19 will do to the education market. But historically, the service sector has seen less productivity than the manufacturing sector, and the manufacturing sector has become so automated in the U.S. that it's a very small part of our economy anymore. So what you're looking for here is what you think going forward. This median is not a forecast. This median is just telling you where it was historically. You can see it's been about 2% productivity, 2% labor growth, 2% inflation. So our economy has grown about 6% over time. And corporate earnings growth, which is the number we're looking for, have grown about that same amount as well. Now, if I update this, and I'm waiting for the second quarter of 2020, so I may not have it in time for our class. The second quarter of 2020 is expected to be a very negative number, and I'm somewhat curious to see how much impact it will have on these historical numbers. So productivity, I think 2% on productivity, that's about what we've averaged the last few years. You might go a little higher than that if you want to argue for autonomous vehicles and artificial intelligence, that they're going to have a big impact, or 5G, or whatever you want to argue, nanotechnology. There's a lot of things out there that could certainly have a huge impact on productivity in the U.S. Battery technology, they just keep coming to mind. There's so many things that could have a big windfall impact. But I would suggest if you get much above 2%, especially if you start pushing up to 3%, you're getting an area that's pretty optimistic, but that's fine. Labor growth, we had strong labor growth this last decade, but that's because we had the first time in our history negative labor growth in the 2000s because of the dot-com bust in the early 2000s, followed by the financial crisis of 2008. We actually had fewer jobs at the end of the decade than we did at the beginning. If you combine these two, you can see labor growth in the U.S., 1% is about what we have, and especially with baby boomers retiring, it's getting tough. Immigration rules are going to be extremely important to labor growth going forward. I really think 1% is a pretty strong number. You look at inflation, the Fed says they're targeting 2%. So I might use 2% there. I want you to come up with your own numbers and justify it. But I'll give you some numbers, just my ballpark. You can certainly stray from it. I don't think anyone will stray too far. I don't think anyone thinks the U.S. economy is going to grow 6%. In fact, 2 to 3% on a real basis, which excludes inflation. 2 to 3% has been our norm the last few decades. You can see the last 2 decades we've just barely gotten 2.5%. So it's been tough getting economic growth, but expected earnings growth, we're just going to tie that to the economy. And so I'm going to use, I'll just give you my numbers. I'm going to use 2.5% for productivity. I'm going to use 0.5% for labor growth. I just don't think it's going to be there. And then for inflation, I'm going to use 2% because that's what the Fed's arguing. Now, you could certainly strengthen your paper since you have Keith Phillips this semester teaching economics, and he's one of the best, if not the best, out there for forecasting these kind of things. He's got a really great reputation, not just in Texas, but throughout the country in the Federal Reserve. I think we're very, very fortunate to have his brain power and his knowledge and background with us. You might see what he thinks on each one of these going forward. He might have he's obviously going to have a much better perspective than I would. I'm a weekend economist and read a lot of papers, but he's got the math skills and the background to really give you some insights on this. So take advantage of having that class while you're working on this to get some really strength added to your assumptions. But if you take that 2.5% plus 0.5%, so that gives you 3% real economic growth, plus 2% inflation, that gives you 5% expected earnings growth. That's the economy, but I'm going to assume corporate earnings grow about that speed. And in class, I'll show you a chart that really supports that corporate earnings in the U.S. grow about the same speed as our economy. The corporate sector and earnings have been historically right at 14% of our economy, and they haven't really moved that far off from that number. So it's really hard for the corporate earnings to grow 20%. The economy is only growing 5%, because over time, corporations start taking over the economy, which means the other two parts of the economy, which are consumers and the government, would have to shrink. And that it's just hard to figure out how that's going to be, given that consumers and the government are the major consumers of corporate products. So this gives us our expected return on stocks. We just add these two together, and you get a 6.9% return. Now, I'll give the option here. I do have a paper. We'll hopefully have time to talk about it, where some people will add an extra 1.5% on the dividend yield. And the reason they do that is that more and more firms today are not just paying dividends, they're also buying their stock back, and they're doing it at such a large level that it's now equal to what, or equal or close to what firms are paying in dividends. It used to be in the past, when firms bought back their stock, they would issue more stock than they would buy back, and so the net was actually a net negative. but the last decade firms have been buying back more stock than they've been issuing. And so you could conceivably add, say, 1.5% here and bring that dividend yield up to 3.4. So I'll leave that up to you. I'll show you the paper. I'm going to stick with the 6.9. And well, the 6.9 actually sounds a little bit low to me. So I'm going to push. I'll tell you what. I'm going to add a little bit. I'm going to add 0.006. I'm going to kind of split the difference on the dividend yield. I'm going to get my expected return, not stocks, up to 7.5%. I'm doing that just because I want you to use your own numbers. So I'm going to put somewhat of a bogus number in there. I do think for expected return on stocks, I really, really do believe that number needs to be, right now, given what we're looking at, needs to be in the 6% to 9% range. Anything below 6%, there's just no reason to buy stocks. If you think that's all stocks are going to give you a 6%, there are some municipal bonds that on an after-tax basis would almost have that same return, and they're much lower risk. So that doesn't make sense to me. 9%, boy, if you think stocks are going to make you 9% when the risk-free rate's only 0.7, you'd probably want to be loading up your portfolio with stocks because that's such a high return. So I think somewhere in that 6 to 9%, you can see I split the difference and just went halfway between. Now the market risk premium. So I'm going to get rid of this stuff. Hopefully you can freeze the video and watch that. So the market risk premium is the expected return on stocks minus the risk-free rate. So we just take 7.5% minus the risk-free rate, and our market risk premium is 6.8%. So that's almost there. We got to do the beta. I showed you beta for Packer. I will do it very quickly here. So if you saw the video for Packer, let's see what we're doing on time here. All right, so I'm going to do it quickly. You already have the video for Packer. I'm going to do it again for Walmart, but I'm going to go fairly quickly on this one because you've already seen it. So Walmart beta. Remember, you go to Yahoo Finance. You type in Walmart's ticker. Well, you're not going to be using Walmart, so you type in your firm's ticker. You go to the historical data. You do the max on the data. You want monthly data. You hit apply. So hopefully this all seems familiar. You did this on financial application, I think number 8. You get the data for Walmart. All we need is the adjusted close because we don't want dividends and stock splits and those kind of things to affect us. So we'll delete everything but the adjusted close. Hopefully this looks familiar. So this is Walmart. So I'm going to bring this over. Remember how we did that? You do your shift and your control and go all the way down. So shift control right, shift control down, then do control C, the copy, and then I'm going to put it into this other spreadsheet. So there's my data for Walmart. I'm going to convert it to percents. So this looks a little better. We get the dates out there. And remember, look at that date, 8/1/72. So we're going to do 7/31/72 to get the S&P 500. So let's go back to Finance Home. Get the S&P 500. That's down today. It was up early in the morning, and now it's down. Same thing here. We'll get the S&P 500's historical data. And remember, if you're seeing the futures, that you want to use this Shift 6 GSPC. Historical data, we want to go back to 07/31/1972. Oh, sorry, I went the wrong direction. Let me cancel and do that again. So do pay attention to what you're clicking on. So 07/31/1972. We want to use monthly data. We're going to apply, and then, whoops, something didn't happen here. So let's put 06/19/2020. So I messed this up. Hopefully you won't mess it up. And we'll download it. It's hard doing a video while you're doing Excel at the same time. But all right, so we'll get rid of everything except for the adjusted close. Although adjusted close, again, does not matter on the index because it is a price-only index. But I'm going to bring everything in, Control-Shift, down arrow, right arrow, let up on everything, Control-C, go back to our spreadsheet, and I'll put that right at the top. And I just want to make sure that the dates all line up, so I'll do Control-Down, and you can see the dates line up. Remember that last month you probably want to delete because the month's not over. So you get rid of that, then you can do Control and your home key or Control up to get back up to the top. We no longer need these dates. So we'll put this as the S&P 500. One thing to be careful of, every once in a while I've noticed, if you have a big problem with your beta chart, I've noticed there are a few errors in Yahoo Finance. You might notice somewhere along the line where instead of $36.20, they have $361. They just got the decimal in the wrong place, and you'll definitely notice it in your beta chart. So if you see your beta suddenly shoot up to a huge number or shoot down to a small number, that may be the case that they have a data issue. And so one way to handle that is you can just do a graph of the data and just make sure there's not any huge spike, because if that went up to $300 and something, it would have gone off the chart. So it doesn't look like there's any errors in Walmart, but just by graphing the data, you can get that. All right, now I'm going to copy these two titles over. And again, remember what we did in application 8, we're going to take the ending value divided by the beginning value minus 1 for Walmart. Change that to a %. Copy it over. Copy that down. And then we're going to do the rolling 5-year beta. So we need 5 years. So we just do 1 and that plus 1. We want to go down a line, probably around line 64, I would guess. There it is, line 62. So we just need, wherever it's at 6 years, right? 5 years times 12 months. 5 years. So 5 years is 60 months. Then we'll put in the beta. We'll do equal slope. We'll do Walmart, the S&P. So there's Walmart, very high beta, but Walmart was a very small company back then. It makes sense this beta was very high then. We'll then do the 0.5, the 0.9, and the 0.1, except for here what I'm going to do is I'm going to take the percentile for Walmart, but I'm going to start like 1985 because Walmart is such a different company now than it was back in the 70s. So I'm going to start 1985. You don't have to do this with your company, but I just want to. I'm going to hit the F4 to lock it in and then do the 50 percentile. So this is actually the median, not for the entire period, but from 1985 only over. And so here's that entire period. Then I'm going to do equal that. And I'll copy those down. And then I'll do my chart. Insert the chart. And here you notice that my median and my 10% down and other, it looks a little bit different because I did it from 1980. I want to put the dates in there, so I'll do select data. Click over here on the dates and get the dates in there. Now I've got my dates. I want to change the dates, format the dates. Remember, all I want to show there is year, YYYY. Something you might want to do when it does labels, mine's not an issue, but if you have a lot of negative numbers, you might want to change your label position to low. So this is Walmart rolling 5-year beta using monthly data. So now I've got my number. I'm going to copy that over and put it over here. And I'll shrink it down just so it will fit on here. All right, so this video is getting a little bit long, but that's just a reminder. Let me do that again. Sorry, that's just a reminder of what we did in Excel application or financial application number 8, I think it was. So you've already done this before on your individual companies. You now just need to do it on whatever firm you're doing for your project. And so I'm going to stop it here. This is not the beta calculation. Remember, the beta has 4 steps. This is only the 4th step, which is the history. So in the next video, we'll finish up beta. We'll get our final discount rate, and then we'll start talking about growth. And we'll probably be able to finish our valuations in the next video, and then I'll do one last video to show you how to do the data table one more time. So again, you're getting some repetition, which is good in this class to get some repetition on the stuff that's very new to you. Do it a couple of times, do it once individually, do it again as a team, and hopefully this will start getting a little more comfortable for you.